Hi, everybody. Hello. Good morning, good afternoon, good evening. We are excited to have you here. I am super excited about this particular webinar and presentation that we're going to do on the digital solutions economy, but with a real focus on lessor accounting. We have what I think is a fantastic, unique, and comprehensive solution that we're going to share with you on how Bramasol is able to address lessor accounting in SAP. So with that in mind, I'm going to remind everybody that the webinar is being recorded. Feel free to ask questions throughout the session. Use that little box down there. We'll try and answer all of your questions online. If we can't answer them online, I will follow up with you personally, or somebody from our team will follow up with you personally. And again, we'll remind you, um, you can download it by going to our website here at bramasol.com. And I want to announce, and I'm excited to tell everybody, yes, this is our 25th year of being in Bramasol, of being in business. We're excited and thank all of our customers, clients, SAP, and certainly our owners, Hasso and Louise, for their support over the past 25 years. Check us out, by the way. We have some great postings and new videos through Facebook and LinkedIn. You can join us on Apple iTunes. We're constantly adding new videos to YouTube, so I encourage you to check that out. And of course, again, you can subscribe to our podcasts, the Big So What podcasts here on either Apple iTunes or iHeartRadio and some of the other areas as well. So with that, let's get into it. I've kind of welcomed, I want to welcome our key speakers and really the team here that has come up with this solution. So let me introduce and welcome um, Julio de la Costa. Julio, you've been here many times before, and welcome to our broadcast.
Good day, John. Good day. Good day.
Prasad Samant, who is the brains, along with Aditya from our team. Prasad, thank you for all your hard work. I think people will be excited, and welcome to our webinar.
Thank you, John.
And finally, what I'll call our master of ceremonies, but at the end of the day, the person who's going to show us what's going to happen here, Sarah, all the way from South Africa. Welcome.
Thank you, John. Glad to be here.
We are excited to have you here. So with that, we're going to dive in. I want to set some context around the digital solutions economy, talk about why leasing should matter or matters to all of you in this space. And then we're going to get into lease accounting. Julio is going to give us some background on the lessor accounting, lease accounting, and it's all in the details, as Julio always reminds me. And then we'll do a fantastic demo. I'm excited for this because I think we have some really cool features out there for you. And again, we'll do a wrap up in questions, but at the end of the day, please feel free to ask your questions throughout the session. So with that, I'm going to dive into what we're calling the digital solutions economy, or the next evolution of the subscription economy. And we all know about this idea of the subscription economy. In fact, subscriptions have been around for a long time. We can all go back to subscribing to newsletters or magazines. Certainly you subscribe to telephone service. So this idea of a recurring payment in return for access to a good, service, or privilege, that's been around for a long time. Again, think of a privilege as your gym. You have the right to go in and use that gym, so you have access to that services. Your lawn mowing is a service, right? So that's a kind of a subscription. But we're talking about more than that. Many companies are now moving to something as a service. SAP offers this fantastic new opportunity for companies in RISE, which is business transformation as a service. But so many different companies offer interface as a service, platform as a service, anything these days I think you can get. You can get automobiles as a service as well. You have entitlements for those of you like me who are gamers or buy software. I run the marketing team, so I buy software to help with that. You have entitlements. What types of software, what other downloads are you entitled to? We have dynamic pricing models. Uber is a fantastic example of dynamic pricing models, but we're seeing more and more companies offering dynamic pricing models for their equipment, services based on market factors, right? You have outcome-based, think printers. One of our companies that we've worked with for a long time, Lexmark, but also HPI and others, offer printers as an outcome-based model where you pay only for the number of pages that you printed. But also companies moving in this direction are insurance companies, right? Think of Progressive or some of the others that base it on miles. You have usage and consumption based, which we're seeing a lot of. Your telcos are that way, but more and more equipment companies are charging for that. And finally, revenue sharing models. And this is just a few of the kinds of companies that you might want to think about that are in that space, where clearly we know US Cellular, the telco companies, but many of these other companies like Blue Apron that provides food, Stitch Fix where you can get food, clothing as a service, gaming, Porsche that offers Porsches as a service or a recurring revenue model. You're not leasing a car, but leasing or paying for the privilege of access to a series of cars. So we're seeing a lot of these dynamic models in place. Why companies are doing this? It's primarily because of three things. Number one is revenue growth. They want to really access new models and opportunities, expand. They're not replacing or substituting, they're adding on. They're taking the products that they already have and adding new ways to consume them. They're lowering costs, in particular focused on managing complex relationships more efficiently, but in many cases they can lower their days sales outstanding. How do they do that? Well, in a recurring revenue model, you have a recurring payment that happens, a regular payment. You're not invoicing, waiting for the customer and receiving that back in time. It's a recurring revenue model that has an automatic debit in many cases. And of course, this is where the world is going. Customers are demanding for it. And this might sound funny, but it really is. The customers are really demanding that you as a business move to these kinds of models. And in fact, in a recent survey by one of the big four and corroborated by one of the large consulting companies, 70% of executives believe subscription models are the future and are moving in that direction. But only a small number of them, less than 10%, have really moved in that direction. So this is a chance for you to be a leader, not a follower. And finally, as we all know in the public arena, it's all about valuation. And we know that Wall Street and the big firms are putting higher valuations on companies with recurring revenue models. So what we have constructed or have believe is what's happening is this idea of the reality of the digital solutions economy. This is a customer-driven model with high flexibility. And what do we mean by this? Customers, your end customers, want engagement on their own terms. They want to use the devices, the time, and the way that they want to engage with you. They want to bundle and do order creation, management, and commerce on their own terms. They want to create the bundles that they need and want, not the bundles that you necessarily have for them. They want to create that order, manage it, and then do the commerce. Click the button so that they can order it and then see delivery and fulfillment. That delivery and fulfillment, whether it's pick and pack or contract manufacturing of a physical good that gets shipped to you, or in the case of digital economy, right? The digital economy, it's in the case of entitlements. If you buy multiple packages from a company like McAfee, Adobe, OpenText, many of these others, there are various packages that entitle you to various rights within that package. How are you managing that and providing and supporting that as you link all of these together? They want unified billing and invoicing. I don't want 15 bills, but I want one bill, but I want it the way I want it. I want flexible payments and collection options as a customer. And finally, privacy, security, and risk. We all know and we hear about hacking all of the time and about people taking information about their PII, PHI, all kinds of consumer protection. And you as a business have to be mindful of this. We're going to talk today a little bit more about lessor accounting, because what we're seeing is more and more companies using leasing as a way to address this opportunity, and they're addressing it by using flexible options, whether it's a consumption model, a straight lease, a flexible lease, variable leases, all kinds of different ways to do that. So what is the connection between DSE and Lessor Accounting? And as my friend Julio says, everything. Think of it, leasing as two sides of a coin. Customers, the lessees, they want to lease the goods from you. And it's becoming more and more common, whether it's a lease model or a rental model, but the leasing of goods and services is becoming more and more common. I know that probably 2-3 times a week, I'm talking to a new customer who is looking at new ways of offering their products and services bundled together, or the consumption models bundled together for their customers. So these providers or lessors have to be more flexible. The changes are more pronounced because the business model requires the equipment that provides these services to typically remain on the books. And so there's this subtle difference. And as we get to the lessor accounting, Julio is going to talk a little bit about the differences between the STLs and the OTLs, because from an accounting perspective, there's a big difference. And we will be showing you how you do that all in SAP. Lots of customers today are using multiple systems. They're looking for an integrated way to approach everything so they can see it all in one place. We have that solution. So without any further ado, Julio, let me turn it over to you.
Yes, thanks, John. So just a quick recap on what brought us here today from an accounting perspective. So obviously there's been two new accounting standards. First one was ASC 606, which is revenue accounting, and the second one is 842, which for some companies are still implementing for private companies. But for the main changes for ASC 842 was really on the lessee side. However, there are some implications for the lessor accounting model in ASC 842. But as you see on the screen there, topic 842 retains the same basic lessor accounting model. So what does that mean? That means that there's a dual accounting model of the operating leases and sales type and direct financing leases. So from a balance sheet perspective, we will de-recognize the asset for financing and sales type leases and recognize the investment and degrade that down to zero. For the operating leases, we continue to hold the asset on our books and recognize depreciation. On the income statement, on day one, as we know, we recognize the income, the profit from the gain or loss on sale of that asset as we de-recognize the asset. And over the life of that receivable or the investment in the lease, we recognize interest income. So you're moving, so on the income statement, and this is very important for our demo today, is you basically have two requirements in a system environment. One of them is to recognize revenue, and then subsequently for a finance lease, recognize interest income. So you stop recognizing revenue, you start recognizing interest income. From an operating lease perspective, you just recognize straight line revenue. So that's the big the big difference in the P&L impact. On a cash flow statement, you recognize the cash received from leases as operating cash for finance and sales type, and the same as operating leases, which is, cash received is classified as on the operating cash flows. John, next slide. So, John mentioned from a high level perspective, what's the big connection between these two accounting standards? Well, if you look, under the covers, you're going to see there's quite a lot of connections. And really, if you think about what John was talking about on the DSE model, you now have companies keeping these customer pieces of equipment and leasing it out. So from a lessor perspective, what is that? That is going to be revenue. And revenue accounting is you have, before you start, as we showed in the previous slide, there's two steps to a finance lease. There is the recognition of the gain or loss on sale of the asset. And secondarily, there's the interest income. And then from an operating lease perspective, there is a straight line revenue. But what happens is, especially in these multi-element arrangements, you have multiple goods and services on one invoice. So therefore, before you even start talking about recognizing revenue or interest, you have to do the standalone selling price. You have to decide what are the goods and services, and I think John mentioned or will mention in some of these invoices or some of these offerings that customers are now doing, there might be a zero price for warranty. There might be a zero price for the rental of the equipment, but the company, the vendor, is making money on usage-based models. So with that, even though you may say, well, I'm not charging the customer any money for the equipment that I'm leasing out to him or her, ASC 606 requires that you have to allocate a value. And that is the key part of it, is that in that performance obligation, you have to allocate value based on a standalone selling price model. Once you get past that and you say, okay, I have a good and service, I have allocated it into a performance obligation, I have allocated value to each of these performance obligations via SSP, then I can think about ASC 842, which is recognizing the revenue and interest income, or recognizing the revenue in an operating lease. So there's quite a lot of interaction. John, any comments on that?
You know, Julio, you hit the nail on the head. I think you and I, almost a year ago or so, when we started meeting with many of these customers, the aha moment was this idea of revenue over time, as we thought of the lease accounting and said, wow, this is really rev rec. And the other one was that important understanding of how many of the customers offer a bundle of products, services, consumables, and the flexible models that are going to be required to manage through the digital solutions economy are going to still have to comply with ASC 606. And so it doesn't obviate having to focus on, you know, all of the fundamental 5 steps that you have to go through for ASC 606. Yes, it's a lease, and leases are handled uniquely, but again, you know, you still have to manage all of those processes. And so we always have some very interesting conversations with our clients, don't we?
Yeah, and John, this is a perfect example of sales and marketing in companies coming out with these great new solution economy models. And then all of a sudden, us in accounting says, well, wait a minute, you have a rev rec implication and you have an ASC 842 implication. So, you know, they've just given us more work, but happy to do those sort of analyses.
We are. And of course, it's great for us because, you know, what it happens is it informs the upstream activities, right? As we look at, you know, in the DSE where customers are looking at both commerce and order placement, our customers, the companies offering this, have to be mindful of, as I begin to bundle things together and offer these dynamic bundles, how do I then reflect that in my revenue accounting? How do I ensure that I've done the SSPs properly, that I've allocated and created the right performance obligations? And if I'm offering freebies, have I created linked performance obligations? Maybe the customer doesn't want to see the bill for warranty and service, but you still have to count it, right? And then, of course, you know, as I'm always reminded when Sarah does her awesome RAR demos, you know, if it's a physical good or an entitlement, what triggers that revenue recognition on some of these items? Sometimes it's overpriced, but for event-based revenue recognition, you have to think about, if I have an entitlement, when do I take ownership? When does that ownership happen? Is it only when I actually access or download that or use that? You know, there's a lot of dynamics that have to go into and thoughtful work, and why we're finding ourselves pulled more and more into these spaces with our customers. So, yeah.
Yeah, interesting conversations.
It's great stuff. We could talk about this all day, but we only want to get to the real gold here.
So just let me quickly go through, you know, what I wanted to go through here is basically the step-by-step lessor process. And then you can take a mental picture of this and you can follow along in the demo, which you'll see in about 5 minutes. So from a lessor perspective, if you think about a finance lease, The first step is obviously you have to de-recognize the asset. So by de-recognizing the asset, you're releasing fixed assets and you're creating this investment, this long-term investment in the receivables. So that's the first step. Once you do that, you have this lessor will recognize a net investment in the lease. Once you have that lease on the balance sheet, it comes in a long-term receivable, and it's basically going to comprise of present value of lease payments not yet received, the present value of if you have any guaranteed amounts, on the present value of the unguaranteed amounts of residual values. So that's going to have your NPV calculations. Once you have that, as we talked about a little earlier, is we're going to recognize that profit or loss in that lease that you've now created. And that is where you have the revenue, you have the cost of goods sold, and you have the resulting profit or loss in the asset that you've just de-recognized. If you have any initial direct costs, those will be recognized as expense. And if there's any difference between the carrying amount and the fair value, it will be as an expense line item. Next slide. So yes, and then lastly, on this side, there's some just things that we want you to consider as you go into this lessor accounting model. It's very important from us, from an accounting perspective. Yes, you will have interest income, and it's the amount of interest that you earned on the investment in the lease. For variable lease payments, very important under 606, also very important from a lessor standpoint, because if you did include any variable lease payments in the initial present value calculation, once you encounter them during the course of the lease, you will have to record them in the profit and loss in the same period that the events were triggered. Impairment is a very important consideration as you go through these leases, because sometimes, let's face it, if you have a customer leasing equipment from you or leasing in a lessor environment, they may stop payments, they may want to cancel it, and then you have to determine, is there any impairment in that? Then you look at things like the net investment in the lease. You always have to, balance the investment in the lease by adding to the interest income and subtracting any lease payments collected during the period. Lastly, for a termination of lease, if any time a lease is terminated before the end of the term, you have to recognize the net investment in the lease for impairment and recognize any loss on the P&L as needed. Next slide.
So Julio, there's a quick question here. Does this mean that lessor income of lease rental needs to be recognized as per Rev Rec?
Yes, definitely. Yes. The answer is yes. It's Bramasol's point of view is very simple. When we start with a lessor, and I'm a lessor, and I am leasing something to a customer, we always start with ASC 606 and understand, follow the 5-step model. What are the goods and services? What are the performance obligations? How do we recognize revenue? Once we follow that through the 5-step model, then we have to follow the 842 guidance from leasing, which is it an operating lease? If it's an operating lease, we have one accounting treatment. If it's a finance or sales type lease, it's another accounting treatment. So the answer is yes.
Yeah, and remember also, so that's great, and remember what Julio said about the other elements. So we're focusing heavily on, from a lessor perspective, the instrument itself or the device or something. Remember also that you still have other elements of your multi-element arrangement that may need to be recognized over time, right? So in the lease, you may, Julio, I assume, let's say that it's a lease for a printer, and I'm leasing the printer, and I have cartridges, ink cartridges and other consumables that go along with that, as well as maybe a software upgrade that I get online and some usage payments or things. Talk about how the instrument itself or the printer is separate from those elements, right?
Yeah, absolutely, and that's the whole point of the ASC 606 exercise. Once you go through the 5-step model, you realize you have a multiple element arrangement. So you have the printer, you have usage of the ink or pages in that example you gave. You may have a warranty, you may have maintenance, and I just called out 4 potential performance obligations. So without understanding and going through the 606 revenue accounting model, you won't know what to recognize when.
Yeah, and there are some exceptions to this. There are some kind of lease exceptions in some cases, but in general, what we have found talking with accounting firms and whatnot is that obviously 606 applies. So let's keep going because I know we really want to get to right.
Next slide.
Next slide.
Yes. And this is actually hopefully will answer the question on the webinar today, which is if we take a simple example of an operating lease, the customer provides the customer with an instrument free of charge in exchange for a usage commitment. The lessor retains ownership. Well, as I said before, and John has been talking about, the first thing we do is we look at the revenue accounting. So the revenue allocation is done up front using SSP approach, and you're going to have 2 performance obligations, lease performance obligation and service performance obligation. Without understanding this revenue accounting analyses, you probably would not be able to do this analysis correctly under the new accounting standards. So this is a good example, John. Hopefully that answers the question.
Yep. All right.
Next slide. And I think once you see the demo, Prasad and Sarah will actually show that part of, in a finance lease example, what they are doing for the present value calculation is the allocated portion of that sales order. So in the example you will see is there are 2 different performance obligations like we saw in the other one. And just to finish up this example as a finance lease, obviously the key point here is lessor does not retain ownership, essentially is selling the tool or the piece of equipment to the customer. So you basically have a financing transaction. In this scenario, the revenue is recognized up front. Again, you're using the SSP approach. You recognize the sale of the instrument on day 1, and after that, you create this net investment in the lease, and you recognize interest income over time. So from that perspective, you also have another performance obligation, which is the warranty. So multiple element arrangement, John. Back to you.
Absolutely. Thank you, Julio. So with that, I am going to pass presentation rights to you, Sarah, and you can take over from here.
Perfect. Thank you.
So hang on 1 second. Let's see if we can get... All right, you're in power.
All right. Well, let me know, John, if you can see my screen.
I can.
Perfect. All right. So before we jump in and showcase what we've got here at Bramasol, I just wanted to talk a little bit about determining the lease classification, whether or not we're going to be utilizing an operating lease or a sales type lease. So in that classification, there are a few different ways to determine what type of lease we will have. So the first option is going to be the transfer of the lease ownership. So if it's just going to be an indicator on the sales contract, or you know that it's going to be a transfer of lease ownership, you can go in and mark that as a sales type lease. We've got the purchase option. So you're going to be purchasing, indicating again that could be something on the sales contract that indicates whether or not you're going to be purchasing, or the customer is going to be purchasing that leased item, so that could be also marked as a sales type lease. The other options are, for example, the lease option if the contract duration goes beyond 75% of the remaining useful life, then we will be posting that automatically as a sales type lease. As a sales order comes in and you've got the instrument useful life, again, you're going to be determining if 75% of the remaining useful life is there, and then the system will determine automatically if that's a sales type lease. The last option is the net present value. So if the discounted lease payment exceeds 90% of that asset fair value, then the system will also automatically calculate whether or not that is a sales type lease. So the first two are going to be information that is given that someone can actually determine whether or not it's operating or sales type. And then the last three, the system is going to actually calculate whether or not it is a sales type lease. So when we first come in, I want to show you three different options. I want to show you a sales type lease or an operating lease first, and then I want to show you how the system automatically takes the sales order and creates that sales type lease in the system. So when we first come in, I want to go ahead and take a look at our revenue accounting contract. So in order to create a revenue accounting contract, we have to start with the initial sales order or sales agreement with the customer. So we'll come in and take a look at the sales orders. Now there are sales orders that I have already out there, and what we've done here is I've actually broken down, here's my sales order information for our sales order, and then we have also the breakdown of what that's actually going to look like on an operating lease. So this actually matches up with what we have within the SAP revenue accounting solution. So when I come in and take a look at my sales order that I have out there that's already been created, this sales order is going to just be set up as you would any initial sales order. So we've got our start and end date on our contract. We've got our instruments down here letting us, or materials letting us know what material we're using for this contract. And what happens is we've got a contract 3901. And 3901 needs to be created into SAP revenue accounting so that that breakdown of those different performance obligations and standalone selling prices can actually happen to determine what's happening. So in the front end, when the sales order is created, it's actually going to be determining whether or not this is an operating lease or sales type lease. So we've got an operating lease here, and I'll actually show you what that looks like when it gets created into revenue accounting. So what happens is we come in to our revenue accounting item monitor, and we'll be determining how we can create our sales order into a revenue accounting contract. So we go into our revenue accounting item monitor. This is the middle process between your operating process and revenue accounting. So what it does is it takes our material and everything we have here. It lets us know that everything is good to go for creating a revenue accounting contract. Based off of our original sales order, this is where it's going to determine what that revenue accounting contract is going to look like. Now, once this is processed through to revenue accounting reporting, we will now, this is the initial step into creating that contract. So creating that breakdown for how our operating lease is going to look from the revenue accounting side. So if we go ahead and come back to our contracts work list, we can manage those revenue accounting contracts. With those contracts, we have a revenue accounting work list. So this work list breaks down all the contracts that we have. So I can show you that I have a new contract that was created. I have 3 performance obligations. Those 3 performance obligations are actually going to tie to the material that we had on our sales order. Now that's important because with our operating type lease, there is no additional breakdown that needs to take place for the interest or any other charges that need to take place. It's going to just have our material that are lined up there. One second while this loads. There it is. So we can see we've got our instrument, our service, and our consumable. We have our original contractual price, but because this is an operating lease, it's just going to take into account our standalone selling price for those 3 items and then allocate the correct allocated amount based off of that percentage. As well, if we were to come and take a look at our revenue schedule for our operating type lease, our revenue schedule is going to show the breakdown of those 2 years that we were looking at for our contract. So we can see here our instrument, our service, and our consumables, are going to be on our revenue schedule, and as those get delivered based off of our customer invoice, we will be able to recognize that revenue. Okay, so when we go to our sales type lease, this is where the system is actually going to be automatically determining whether or not this is a sales type lease based off the same information that we're putting into our sales order, but we'll have different dates. So it will be based off of the percentage of the useful life. So our percentage of useful life is going to be over 75% for this particular contract. So we can come in, I'll go in and show you the revenue or the sales order first, and then we will create a revenue accounting contract again, and that will actually show you the revenue accounting contract will show you the revenue schedule and how that is created. But on the sales order, we'll be able to see where you're determining the sales type lease. Okay. So we first come in here, you can see here we now have our useful life of 7/2021 to 2026. So we have the useful life of more than 75% for this contract. If I were to drill into my instrument here, we can come over and see we actually have the item for standalone STL. So because this has been created, it's got the additional information for us to see. Here's our interest, STL category brought in, the useful life. This was determined. So here's the useful life that we have. 84 with 75%, and we're looking at a 66 months. So we're over the 75%. So this automatically flags this contract as a STL contract. Now, if we were to use MPV method, which we will use on our next contract, we'll be able to see that here as well, and that will also determine whether or not that's a flag for this particular contract. So we'll go ahead and take contract 3902, run it through our revenue accounting monitor, and we'll actually be able to see our revenue accounting contracts. So we're running the same process. Our standalone our sales order has not created any revenue accounting contracts. We would see those here. I'll go ahead and process, and then we can actually drill into those revenue accounting contracts from this work list. So we have created revenue accounting contracts now for both local GAAP and IFRS, and we can drill into those revenue accounting contracts and actually take a look at how that schedule differs from an OTL contract into an STL contract.
So while it's processing, Sarah, what I thought was fascinating on the other screen is you had both tests there, and of course we know there's 5 tests, but you could see that it passed one test as an OTL, but on the other one, on the useful life, it did not, and therefore it became an STL. And all of those decision rules are happening in the background. So
Correct. Yep. That's very important. And then because it ran through that process and automatically determined that it was an STL contract on this one versus our original OTL contract, we can see we had the same material, everything set up there, but this instrument actually broke out into the principal and interest on the revenue accounting contract. So we'll see here we have what we call linked performance obligations. And with those linked performance obligations, they weren't on our original sales order, but they're the breakdown of that original material that we had for that instrument. So based off of our standalone selling price and our breakdown here, we can see that there will be no allocated amount to the instrument, but it's actually allocated amongst the principal and the interest. And then if we showcase our revenue schedule, we will be able to see, in addition, how that kind of breaks out over the life of that contract. It will break out the time-based revenue for the principal and the interest. So we can see here it's no longer based off of the invoice, but actually you'll be showcasing the principal and the interest for every month that we'll be able to recognize that revenue. And then one last one, we won't get all the way into the revenue accounting contract, but just to show you again, on our sales orders, if we were to determine a standalone or a sales type lease based off of the net present value, it's going to run through, again, that same process that we just showcased here with our useful life contract. But when we come in, again, we're taken to a sales order. This time we're looking at, we're going to be looking at sales order 3903. And then we'll go ahead and take a look again into drilling into our instrument, and we can drill all the way down into our determination. So if we come here, it passed our first few tests. It passed our test for the useful life. So we're only looking at useful life of 12 months on this contract. So the percentage is only 14, which doesn't exceed our 75% minimum. But we're looking at the actual NPV, which surpasses our 90% of the fair value here. So that's why this contract will now be flagged as an STL contract as well. So when this one does get created, it will look very similar to the contract that we had for our last contract.
Right, and I think it's important to note that although this happens automated and we do this for the purposes of a demo, with a customer, what you would have is a acknowledgement of this is the determination. Do you agree with that determination, so that you as the accounting team in your customers have the ultimate determination of yes or no, right?
Correct, John.
Mm-hmm.
So I think from here, I'll go ahead and turn it over. Julio, if you had anything you wanted to add just on what we've seen here, or any last comments, and then I will turn it back over to you, John, to kind of close this out.
Yes, sir. From my perspective, I think what what Bramasol has built is a lot of customers we talk to ask for an end-to-end lessor process, and obviously a critical part of that lessor process is you have to follow the accounting guidelines. So there's criteria, the 90%, the 75% useful life, the NPV, is there a purchase option at the end? And what our engineers have done is include that decision tree into an accounting for lessor accounting process. So I think it's very intuitive that as you start getting these contracts or these sales and orders from whatever system you're using, this tool is actually going to intuitively start looking at the criteria, and once the criteria is met, it's going to push it into an accounting work stream, whether it be the gain or loss on sale and then interest income, or simply stick with revenue accounting and does the simply revenue recognition on an operating lease on a monthly basis. And I think one last thing, I saw something in the notes there, in the question, is it can be a little confusing to understand what guidance to apply, whether it be 842 or 606. But as we mentioned earlier, you can't start recognizing a finance lease or an operating lease without first understanding the basics of the contract. And any lessor contract between a vendor and its customer is considered a potential revenue accounting contract. And that's why, if you look on any of the Big Four guidance, you always have to start with, is this a revenue contract? If the answer is yes, it's much easier when you follow the 5-step model. Once you follow the 5-step model and you assess whether it is a revenue contract, what are the performance obligations, how are you going to allocate those performance obligations within that contract, then you pass over to lease accounting. And there are certain practical expedients under ASC 842 that says you can actually combine lease and non-lease components and follow 842, or you can stick with ASC 606. So there is a little bit of complication between the two standards, but I think any good technical accounting team, or obviously your accounting advisors can, or even Bramasol can help you walk you through that process. With that, I'll turn it back to John.
Yeah, sure. Julio, I think the other thing while Sarah has this still up and before we transfer up, I take control is, again, I want to point out what we have done here is provided an option or a view of the determination of STL and OTL in a systematic way, right? There are, it's happening in the background, it's automated. A lot of customers come to us because they're using other tools that aren't quite as robust as SAP, and they'll say, well, do you have an STL OTL tool or app or something? And the answer to that question is no, not really. Yes, we have a methodology and an approach that is part of SAP that we have built into SAP to make that happen, leveraging the tools that exist. It is, customization. It is a methodology approach that we have come up with that leverages some really smart work that our team has done around how to leverage existing tools within SAP and enhance them a little bit. But it's in there, it's built in, it's part of the process. So with that, let me transition over.
And John, I think there was a question as well about whether Bramasol offers an end-to-end process in the comments there. So
yes, so there was a comment there. We do offer it as an offering. If you come to Bramasol and you have your accounting done or your Lessor accounting process done, we offer that as part of our services, our accelerators, tools, and IP. Certainly, we will look into whether or not we want to appify that, but right now it's really part of our core intellectual property and accelerator tools that we offer as an organization. So with that, I'm going to attempt to share my screen. See how that goes. It's not letting me take control. Sarah. Let's try change presenter, show my screen. There you go. Sarah was in charge.
All you, John.
That's all. So it's all about me. There you go. There is another question. Maybe Julio, you can address it while we wrap up. So why Bramasol for the digital solutions economy? Well, as I mentioned before, Bramasol has been in business for 25 years partnering with SAP. We have some of our great SAP colleagues on here with whom we partner from the services and the development teams and offer and talk about some of these innovations. We have deep financial acumen. We've been doing SAP finance for over 25 years. Our team, generally speaking, Julio is a CPA. Many of our members have or had CPAs and have deep finance experience. And we bring this perspective to you in this solutions economy to help you understand, well, it's great that you want to offer these bundles, but from an execution of finance, billing, revenue accounting perspective, how do you make that happen? How do you do it smoothly and in compliance? As you can see, we are the deepest experts. We get called in by the Big Four, Fortune 500. We support and consult with SAP. We have probably the deepest and some of the most experienced experts on the planet in SAP revenue accounting. We've been doing cloud for over 10 years. When I first joined Bramasol 10 years ago, we were doing cloud-based applications, including by design and others. I mentioned our co-innovation with SAP. Deep industry expertise, as you can imagine, doing all of this revenue accounting, we've become deep experts in areas such as media, software, high tech, IM&C, oddly enough, telco, utilities, all of these we bring to the fore, life sciences and media. You can see that we're very agile and nimble. We try to give a thoughtful approach to innovation. As we work with each customer, while we prefer and work on a fit to standard or a methodology, we like to innovate and we help you think about your business differently. We've talked to businesses, for example, about how do you turn a smokestack filtering and monitoring device business into a subscription business? Can you measure it on the cubic meters of air filtered, for example? So, and can you use it as a platform for information? And finally, we have a proven record with leaders in the digital solutions economy, companies such as McAfee and many others who we've done, Hewlett Packard, Google, Apple, you name them, some of the innovators in the digital solutions economy. So that's why Bramasol. I think the takeaways for me here and for you, I hope, is the digital solutions economy is here to stay. The world is moving in that direction. So many more customers we have and so many more of yours are forcing that and moving in that direction. Leasing is a core aspect. We thought early on that when ASC 842 came around and required people to move their leases onto the balance sheet, that people would shy away from that. And what it's turning out is more and more customers want leases. They want control over how they consume a product or service. And think of, in my days when I was in telco, you used to lease out a piece of iron, you leased out a PBX. Now, a lot of companies on the forefront of that are leasing out access to a PBX or a CIC or any of those kinds of things on a user basis, on a volume basis, configuring it on a software basis. The basic ways that we consume things are changing. Technology is part of that solution, not just the whole thing, but part of that. We have a perspective and we'd love to talk with you more about how technology can be the enabler to you, particularly with SAP Intelligent Enterprise. And finally, we want you to get a partner who can help you across disciplines. There are a lot of companies out there who profess to have expertise in many different areas. We demonstrate our success day after day in our expertise as we do more and more revenue, lease, treasury, and digital solutions economy style projects with companies who are really growing in innovation, whether it's in banking. The cannabis industry is yet another industry that we're seeing huge growth in. So I want to thank Julio and Sarah for this phenomenal demo and discussion. And I want to publicly thank Prasad on our team and Aditya, who behind the scenes made it all possible. So with that, I'm going to wrap up. I want to thank all of you for coming, and I hope you all have a fantastic day. And again, Sarah, Julio, and Prasad, thank you for all you've done.